Welcome to my channel Fiscal Voyage. I'm Felix. If this is your first time visiting the channel, make sure to subscribe because I'm doing a series of Dividend Aristocrats, which are companies that have been growing dividends for 25 consecutive years or more. So hit that subscribe button and stay tuned for tomorrow's video. And in this video, we're going to do a stock analysis on Albemarle. At the end of the video, because I want to provide you with a fair value price, and we're going to determine if it's a buy, hold, or sell at current prices. Okay, Albemarle Corporation, ticker symbol ALB. Is a specialty chemical manufacturing enterprise. Albemarle is a leading global producer in lithium, bromine, and catalyst solutions. If we go to the fundamentals, the company grew revenue at 4.8% from 2010 to 2019, which is a modest rate here. Net income did slightly better at 5.7% in that same time period. The company has a credit rating of BBB, which is investment grade, and operating income from that 10-year period, 5.2% annual growth. Earnings, however, had a better performance in 6.1% annual compound growth. And for the past 5 years, earnings grew at 11.3% as well as net income at 12.3%. However, revenue for the past 5 years has been negative 0.4%, so it's been flat. But they've been growing net income and earnings in that 5-year period. If we continue with the fundamentals, last year they had earnings of $6.04. Net margin came in at 14.9%. This was lower than 2018, where they had a net margin of 20.5%. Return on equity at 14.2%. This is also lower than the return on equity on 2018, but it stays in line with their 5-year average. Current yield has a very low 2.01%. So I personally like to see companies at a 3% or higher, maybe 3.5 and higher yield, but at 2.01, that's not attractive here. The 5-year growth rate is nice, 6.2%, which is double the rate of inflation. Is good. Nice, decent growth rate, but at this kind of growth rate, I would like a yield that's like 4%. But let's continue. Dividend payout is very safe at only 44%. This is based on 2020 expected earnings, which is going to be lower. We'll talk about that next. But right now, the payout is good, 44%. So the dividend is very well covered with earnings. And they've been growing dividends for 26 consecutive years, so that's great. So this is a dividend growth company and a dividend aristocrat company. So that's good there. The most recent dividend increase was 4.8% in February. So that's good here. So even in the pandemic, or kind of before when it started, they increased the dividend. So that's a plus. Another plus is the 5-year dividend yield average is 1.65%. So the current yield, you get a little better yield than their 5-year average. And the charter rule is only 8.2 points, so that's not good. I like to see it 10, 11 or higher, and we're only getting a charter rule of 8.2. That's because of the low dividend yield. Like I mentioned, I would like to see it at 4% or 5% if it's only growing it for the past 5 years at 6.2%. So if we look at the balance sheet for the company, it's pretty good actually. Debt to cap at only 45%. The current ratio is only 1.58. That's kind of where you want to see it, or higher. 1.5 or higher, so this is good here. It passes that, which is the current asset divided by the current liability, so they have more asset than liabilities. The debt to equity ratio is good as well at 0.76. You like to see it under 1 and lower. That's a good rate here to debt to equity ratio. Price to book is also favorable, 2.10 versus their 5-year average 2.56, so that's a plus there. So their balance sheet is solid, with a nice credit rating of BBB, investment grade. So we look at the future outlook. Analysts expects 2020 to come in at $3.70, which is lower than the 2019 earning of $6.04, which is a 39% decrease. Of course, this is because of the pandemic and the economic slowdown, so that's why the earnings has dropped 39%. However, they're expected to pick it up back up in 2021 at $4.60. Still, it is lower than the 2019 earnings of $6.04. CFRA has a projected compounded annual growth of earnings of 6%. And doing my dividend yield return model, I get a projected return at current prices at only 8.6%. So that's it's decent return, but I would like to see it higher, 9-10% or higher. So that's something to consider here. And forward PE at 20.7, which is right in line with the 5-year average, and that's because the forward PE is based on the $3.70 earnings this year. The company tends to follow a PE of about 15, and we'll see that here in the fast graph. The blue line is the normal PE ratio of 15.8, and the orange line is the earning with a ratio of 10.66. And of course, the black line is the monthly closing price. As you can see here, the negative 39% drop in earnings for 2020. That's hurting, the valuation here. As you can see, if we expect the price or earnings to go to 2021 at $4.60, it could only generate a negative rate of return at these prices. So, and also, as you know, 2016 and 2017, the price was very high, so that drove up the normal PE. So maybe an actual normal PE might be around 11 or 12 or 13 PE. So right now it says 15.8, but that's because 2016 to 2017 it was a high price valuation. And you can also note that from 2013 to 2016, revenue or earnings was pretty flat, and then they picked it up at 2016 to 2019 very nicely at 29%, 19%, 10% growth. And on the right, you see the blended adjusted earnings yield of 6.64. It's okay there, but I would like to see it around 8% or higher. And also the dividend yield is low at 2.01%. So over here, it looks kind of like the company is fairly valued, maybe even a little overvalued for me based on the fast graph. So if we go to the fair value price section here, CFRA has a fair value of $89, Morningstar of $125. Fast graph at 72, Yahoo at $70.33, and my dividend discount model analysis at $41.55. My dividend discount model analysis, I use 6% for the next 3 years and 5% after that with a discount rate of 9, and that was still conservative, and I don't like that the price came in at $41.55, so that's something to consider there. But averaging out the 5, we get a fair price of $17.86, and currently the company goes for $76.52. So that means it's undervalued by 4.4%. So with that, I have a recommendation as a hold at current prices. And the reason for that is because the earnings growth has slowed down, for this year and next year as well. The dividend yield is very low at only 2%, and also I believe that the company will be undervalued if the price to earnings ratio was around 10 or 11. I think that's a good buying opportunity at that price point whenever the price to earnings ratio is 10 or 11. But the balance sheet looks good. The current ratio of 1.5 is real nice, and the debt to equity ratio is low as well. The dividend coverage is very good as well, only 44%, so that dividend is very safe. But like I mentioned, it's only 2%, so it's very low yield. Projection of earnings or price appreciation is very low currently, so that's why I have a hold recommendation. If you enjoyed this video, make sure to hit the like button. It helps with the YouTube algorithm. And make sure to subscribe, because tomorrow I'm going to be uploading a new video, a new Dividend Aristocrat. So I'll see you tomorrow, guys.